of University of Colombo, I warmly welcome all the local and global participants who have joined us through Zoom, YouTube, and Facebook Live to our current year's second evening forum, the webinar on post-COVID financial markets. We are happy to have today a very distinguished panel of speakers comprising Mr. Kanishka Pereira from Asia Securities Wealth Management Limited, Ms. Vindhya Jayasekara from NDB Wealth Management Limited, and Mr. Udeshan Jonas from Capital Alliance Limited. The MBA Alumni Association is a voluntary organization and consists of diverse and dynamic MBA graduates of the University of Colombo. We are an independent group of professionals affiliated to the University of Colombo. The association has been in existence since 1997. As a professional organization, we focus and capture socio-economic and professional issues in the country through various activities and programs such as management conferences, budget seminars, evening discussions, trainings and coaching sessions, etc. You will of course understand that this is a very unusual period since the onset of the COVID virus and the subsequent lockdown. Our economy and our workforce suffered immensely. I understand that many of citizens would have faced redundancies, loss of income, and several medically imposed restrictions. Everybody believes that we will not go back to what was there before the pandemic. Therefore, we have now to accept especially the technological changes and adjust ourselves to the future. This will be the challenge we are facing in the current context. Having realized these revolutions in work ethics, we set this year's theme as the Embracing the Agile Revolution, which attempts to embrace the disruptions and changes in progress. For these new changes are what our members and organizations will work with if they want to survive in a fiercely competitive socio-economic environment. So, we are here today to hear of the challenges, strategies, and opportunities to optimize the investments in post-COVID business environment from this experienced and eminent panel. To start the proceedings, I would like to invite the moderator for today, former banker and our own alumnus, principal consultant at JKSC Consultants Private Limited, Lasintha Ferdinando. Over to you, Lasintha.
Thank you very much, Ranga Ratnayaka, President of MBA Alumni. And let me warmly welcome all the participants especially, and the panelists out there whom I will introduce just before their initial introductory remarks. Let me first take you through the format of the day's proceedings. There'll be three sections of the day's proceedings. First section, we will be giving 10 minutes each to the panelists. They'll be talking on the macro perspective, then the interest environment, then the investment opportunities and the capital market status. So that's the first section of the day's proceedings. Thereafter, we will go into looking into the challenges as well as the risk involved. And then the third, we will go into the most interesting part, the strategies and how to optimize your investment opportunities, strategies, and yes. So to start with, let me warmly welcome our first speaker, Mr. Udishan Jonas. He is the current chief strategist at Capital Alliance Limited, who's overlooking the research function. And he has won 2 awards in 2017-18 at CFA Capital Market Awards. He's a CFA charter holder as well as associate of the CIMA UK. And he holds a Bachelor Business from Edith Cohen University, Australia. And he's a visiting lecturer at CFA Institute as well. So, Mr. Udishan, we'd like to know the macro perspective of the current environment of Sri Lanka. Over to you, Jonas.
Sure. So, thank you very much, Rasinta. So, before I go into the nitty-gritties of what our outlook is, I just want to give you a view in terms of what has happened up to now in terms of the economy and where we stand right now. So let me share my screen in terms of a few slides to go through in terms of what we are looking at right now. So as of August 2020, from the year at the beginning of January, we saw the central bank being very optimistic in terms of the growth numbers that they were looking at. They initially started out by saying that they were looking at about a 4.5% GDP growth. This was on the back of the several tax measures or tax cuts which came in towards the latter part of 2019. There was a reduction in terms of value-added taxes, income taxes being cut down, taxes on SMEs, various tax incentives which were given to the public. So on the back of the fiscal stimulus, the government and central bank was optimistic on the growth numbers for 2020 on the back of the support of the recovery cycle that we saw from the Easter Sunday bombings in April 2019. But unfortunately, COVID kicked in towards the latter part of first quarter 2020, dampening our GDP growth expectations for 2020. So the central bank has brought down the expectation to about 0 to 1.5% of positive GDP growth for 2020. And in light of this, with the slowdown and the lockdown exerting pressure on the economic fundamentals, the central bank went through a phase of monetary easing cycle where rates were cut down by roughly about 200 basis points, followed by SRR cuts or statutory reserve cuts of roughly about 250 basis points since the beginning of the year. In addition to this, the central bank also printed money by purchasing treasury bills and bonds from the market, which infused about 300 billion rupees to the market, creating the current liquidity of around 180 billion excess liquidity in the market right now. So right after April, we saw the rupee also taking a tumble, with the rupee depreciating about 198, 199 by May or towards 9th April to be precise. But this kind of started reversing towards the second quarter of 2020 with the import controls coming into play and the dollar also kind of seeing some kind of weakness. With the lockdown being eased, we've seen the recovery kind of taking place with GDP numbers getting back on track. The purchasing manager index showing signs of recovery, but the growth has been slow and not a V-shaped recovery as what we expected to be. So to give our view in terms of what Cal is looking at is in terms of a GDP growth expectation. We are looking at a negative GDP growth of about 3.9% for 2020, which is way lower than what central bank is expecting at between 0 to 1.5% positive growth. We saw the first quarter GDP growth numbers coming at a negative 1.6%. The second quarter will be the one which is going to be the worst hit, given the impact of 55 days of lockdown, which may result in our our GDP growth coming down to about 6.6% down for the first half of 2020. We are seeing a recovery cycle in the second half of 2020, which may bring the overall number to about 3.9% negative GDP growth. So we are looking at a negative GDP growth number after 2001, after the airport bombings having an impact in the 2001 GDP growth numbers. So this is one of the worst years that we've seen after 2001 in terms of the GDP growth numbers. Also, a keynote in terms of what we need to look at is what we call an annual output gap. Output gap, which is showing what the actual GDP growth is versus the sustainable or long-term GDP growth trajectory, which indicates that there will be a negative output gap for at least the next 3 to 4 quarters, which is something that the central bank will be watching out in terms of what kind of stimulus that they need to keep pulling back to the economy in terms of fueling the economy back on track. So in terms of the economic recovery, we are seeing the market or the economy recovering, but it's at a gradual, slow pace. The reason being that I will talk about in the next slides, but if you look at the indicators, we are seeing electricity consumption, which is a proxy to industrial consumption, is getting back on track. We are seeing numbers getting back to where it was before. And also, if you track Google mobility trends, which indicates transportation activities to certain segments of the economy compared to where it was before pre-COVID levels. So if you look at how the consumers are transporting towards retail and recreation, we've seen in the week of August 24th to 30th that compared to pre-COVID levels, the activity levels are back up 7% year on year. And if you look at the peak lockdown period, these numbers were down by about 83% compared to where it was during the pre-COVID levels. So grocery, pharma, retail, we are seeing numbers improving year on year. But if you average it over a month or so, you are seeing numbers still down by about 3 to 4%. So we are seeing signs of recovery, and also in certain segments of the economy, there has been certain level of pent-up demand that we've seen, where consumers have been avoiding certain things on the back of the lockdown, which now they are back on track and started consuming slightly higher than what they were doing before. So if you look at the FMCG numbers that are coming out from listed FMCG companies, you are looking at somewhere close to negative 2 to 3% in terms of volume numbers in terms of FMCG growth right now. So trend is improving, but it's at a slow pace. Why we see this trend to be slow is due to three main reasons. One is tourism, which accounts for roughly about 4.5% of GDP, is at a complete standstill, which is going to make the contribution from tourism fall to about 1.5% this year compared to 4% last year. And GDP was at the high, it was about 5% of GDP. And this is going to have a larger bearing on the hotel sector, as well as the segments of the economy which are directly dependent on tourism. And we don't foresee tourism numbers getting back on track until the lockdowns are reversed globally, internationally, and also consumers or the travelers getting back on track in terms of adopting for international travel. The second largest component is obviously apparel exports. So we've seen the apparel sector taking a significant toll, with the US and Europe, the largest markets, taking a significant hit in terms of the economic activity. So even though initially we looked at about a 30-35% decline in terms of apparel exports to these countries, the numbers which came in from June, July look positive because of the PPE, or the the protective equipment demand that came in. But we are right now we are seeing the demand for personal protective equipment falling, which means that the demand for organic growth in terms of textile is going to be subdued for the next 3 to 4 months. We are seeing retrenchments coming from the apparel companies, which will also lead to unemployment, given that they employ about 400 to 500,000 employees in this sector. So this sector will have a bearing in terms of putting the brakes on the recovery that we are seeing in terms of GDP growth. Also, the other component being worker remittances. Worker remittances have been on a negative territory, with work remittances year to date being down by about 5.5%. But overall, work remittances are a large part of the economy, accounting for about 8.5% of GDP. So these three segments will have a bearing in terms of consumption of the overall economy, and push down the growth recovery cycle that we've seen in the last month or so. So which is why we are seeing growth recovering, but at a relatively slower pace compared to what it was. Overall, we are looking at growth numbers hitting back to old levels somewhere close to the second half of 2021. The larger problem that Sri Lanka will face is the issues faced in light of the fiscal pressures that we're seeing right now. So in terms of fiscal deficit, we are seeing fiscal deficit crossing close to, or will cross close to, somewhere around 10% of GDP. This is on the back of significant revenue shortfall that we are seeing, with tax collection being an issue and companies not doing that great, and also in terms of the significant tax cut measures which came in at the beginning of the year. The problem that we have right now is that the significant fiscal deficit is going to have a dampening effect on the debt position of the country for the next 2 to 3 years. So if you look at our debt to GDP, we are hitting at about 92% of GDP in terms of government debt, which will soon be close to 100%, which is a bit concerning right now. So even though Sri Lanka is recovering faster in terms of recovering from COVID compared to the other countries, the problem that we have is we don't have the fiscal measure to give stimulus like what the other countries are doing right now. So if you look at the US and other developed countries, roughly 5% of GDP has been towards providing fiscal stimulus to the economy. In terms of Sri Lanka, we've seen less than 1% in terms of fiscal deficit going in terms of the economy. So this is going to be a significant problem for the Sri Lankan economy, which might slow down the trajectory that we've seen in terms of the recovery cycle. Also, from an inflation perspective, what is positive right now is that the printed money is not leading to significant demand-driven inflation. We are seeing inflation numbers for August coming in at about 4.1%, still at the low bound of the central bank's target of 4 to 6%. And in particular, core inflation is still at about 3.2%, which is quite good in terms of keeping demand-driven inflation under control. Food inflation, on the other hand, has been significantly high at about 13%. But we see that coming down with weather conditions being conducive, and also now the government looking at positively in terms of bringing down prices of certain goods in the next couple of months. So food inflation will come down, and we see inflation edging lower in the next couple of months. So to kind of summarize, we are looking at GDP trajectory on a recovery cycle, but it's a slow recovery cycle where GDP growth will get back to 2000, where it was back again in the second half of 2021. Fiscal deficit on an upward trajectory. We are looking at about 9 to 10% deficit to GDP. And even if we recover from the COVID cycle, our deficit to GDP will still be at about 8 to 9%. In the inflation side of things, inflation is kind of under control right now, with inflation being at the lower bound of 4% of the central bank's target, which is good and which kind of facilitates the easing monetary stance from the central bank. So that's my view in terms of from a growth, fiscal, and an inflation perspective. Over to you, Lasinda.
Thank you, Dishan. It was very comprehensive in a short span of time. And I would like to invite all the participants, do log in and send in your questions. We will take it, in fact, at the end of the session, but I will be reading it from now onwards. And if there's anything relevant, which is very important for the subject what was covered just before, we might take it up. So we'll move on to the next speaker, that is Mr. Kanishka Perera. He'll be touching mostly on the fixed income sources and the interest rate environment. Mr. Kanishka Pereira, he's the Chief Investment Officer attached to Asia Securities Wealth Management, and he's responsible for managing investment portfolio across multiple asset classes. Prior to this, he was the head of research with Asia Securities. Before Asia Securities, he was with Moody's Analytics Knowledge Services, and his team has won many awards at the CFA Society Sri Lanka awards ceremony. And he holds a BCom from University of Melbourne. So next 10 minutes, over to you, Kanishka.
Right. Thank you for that, Lasintha. So let me get my screen shared. Oh. Udishan, I think you need to unshare yours. All right, perfect. Right. From the beginning. Right. So what I will do is I will give a brief overview on where interest rates have gone to, what really drives it, and what we think will happen over the next few quarters and years, and essentially what our view is in terms of interest rates. So just to start off with, I mean, what we have seen is with all the liquidity that's been coming into the market, we've seen interest rates fall into some of the all-time lows we've seen since the data is available. So far this year, your T benchmark 364 T-bill has dropped about 350 basis points, while your 1 years, 5 years, and 10 years have also seen substantial declines, primarily because of the liquidity that's been released, as Udishan was mentioning earlier, and very little activity that's going on with economic slowdown. Obviously, credit demand also collapses. So one of the things which we've heard about is, with dollar interest rates where they are, I mean, shouldn't rupee interests also come down to a certain degree? I mean, this is true in some instances. If you look at the 3-month LIBOR versus the LKR interbank rate, you can see in some instances it follows the trend, and some instances it follows the USD rates as well. But what we see is that whenever there's a BOP crisis, the rupee rates tend to move completely different to where the dollar rates are going, because it's primarily due to the risk that we see these movements coming along. So in a nutshell, I mean, what really drives interest rates domestically? It's essentially liquidity. Now, this blue line shows you the liquid assets in the banking system versus the total assets in it. On the left-hand side, you can see the axis. So a higher number means higher liquidity in the system. And you plot that against the 3-month T-bill rate and versus the prime lending rates. You can see that as liquidity increases, interest rates start declining. So this is the primary driver of interest rates. So the next question which anybody would have, obviously, is what really drives liquidity? And the answer to that is fairly straightforward. It's credit growth. Since 2010, you can see as credit growth increases, your liquidity levels come down. So the left-hand axis is essentially, an increase in credit growth. And on the right-hand side, when you look at it, you can see liquidity starts decreasing. Now, so far, I mean, what we have seen is that credit growth has been very weak, especially from the private sector side, and there has been a substantial amount of government borrowing that's come into place. If I give you some numbers, I mean, on average, for the first half of this year, private sector credit demand has been about only 6 billion rupees on average per month. Whereas if you historically it stood somewhere around 25 to 30 billion rupees a month. Whereas government credit requirement, that is the central government and public institutions, has shot up to roughly about 150 billion rupees a month. And last reported data for July showed roughly about 200 billion being absorbed by the government and the public sector. Now, in this kind of situation, usually you will see high interest rates, which is something which we saw in previous years as well. But in this instance, what we see is that, the private sector credit growth has virtually collapsed to almost nothing. So there is enough liquidity running around for the government to continue borrowing domestically. And this is a key point because accessing international funding lines right now is a bit of a difficult task given the risk perception that's there. So overall, I mean, what we see is we see a couple of scenarios which can play out. For that, I mean, if you look at some of what has happened in the past, you can see from 2008 to 2010, interest rates declined. But in this case, if you look at the black line, you can see that deposit rates also came down. So the banks maintained their spreads and ROEs weren't too bad. But the 2012 to 14 decline was worse, where there was virtually no interest spread, which afterwards, if you look beyond from 2014 onwards, led to a sharp increase in interest rates. Right now, we are looking at a scenario similar to what we saw in squeeze between 12 to 14. Essentially, I mean, we're at what we say as an inflection point where things can go either way pretty much. So our view right now is that over the next, 3 to 4 quarters, at least until middle of next year or until the third quarter of next year, you will see interest rates moving sideways. There might be a reduction in policy rates coming towards the end of the year if there is insufficient economic activity. But what the central bank and what we can all see is that even though rates are low, people are not necessarily borrowing, primarily because of the risk that's involved and the uncertainty that's involved with current economic conditions. But beyond that, what we think a key thing to keep an eye out for is on import controls. Once import controls are released or relaxed to a certain degree, we will start seeing a sharp recovery in or increase in interest rates coming into play. Because our view is that, I mean, very similar to what Udishan was saying, this fiscal deficit will also be a bit of a problem going forward. I mean, it's not something that's going to be resolved by middle of next year at all. So all throughout next year, we see government sector credit demand being high, can be anywhere between 150 to 200 billion per month. But this depends to a large degree on international funding lines, what they can raise from those as well. And you add to that the private sector credit demand, this excess liquidity of 200 billion will just literally just vanish in about a month's time at most. So overall, our view is that we think that interest rates will move sideways, maybe see a bit of a dip over the next few quarters, and then see a sharp increase from that point onwards. So yeah, just to reiterate what we were saying, rates are at one of the lowest points. The dollar rates have some impact, but BOP position is more meaningful there. And liquidity is the primary driver there. So our key thing, what we look for is, what's essentially going to drive credit growth when it comes to our asset strategy in terms of whether we go into, long tenure or short tenure in terms of the fixed income space. With that pretty much brings my little presentation to an end. Yeah, thanks.
Thank you, Kanishka, for that very insightful presentation and remarks. Moving on to our next panelist, we have the pleasure of Ms. Vindhya Jayasekara. She's the Vice President at NDB Wealth Management, and she's a CFA charter holder as well as a graduate in civil engineering, what a contrast, with first class honors from the University of Moratuwa, and she's a recipient of Fulbright Scholarship, which she completed her MSc in Finance at the University of Illinois USA, and she got a medal for academic excellence there. And she's a qualified financial risk manager as well. And with her work experience, she was with NDB Investment Bank before, and she had been at Lehman Brothers USA, and count for nearly 2 decades of experience in the wealth management as well as investment banking. And at the moment, she has about nearly 150 billion under her management. So she'll be touching upon the investment climate, as well as how the foreign investors, they look at investments in Sri Lanka. Over to you, Vindhya.
Sorry. Thanks, Asinta. So before I just touch on the investment climate, let me just share my screen. Yeah. So let me just quickly touch on exchange rates and then move on to stock markets. In terms of exchange rates, right now, LKR has depreciated by about 2.43% as at August 31st. So when you look at the exchange rate movement, you see that pretty much the rupee has depreciated against all major currencies. And despite the fact, like Udishan mentioned, we had a very high depreciation just pre-COVID, and or actually in the middle of COVID, and afterwards, May, June, and July, we've seen that rupee actually appreciated over the last few months. But again, in August, we are seeing a mild depreciation. Part of the reason of this rupee appreciation, of course, comes with the fact that US dollar movement against other major currencies, as you will see in the second graph. The US dollar has also seen depreciation against other major currencies, especially in July and in August. So in that sense, rupee appreciation partly can be attributed to that. In terms of looking at gross official reserves, right now our gross official reserves stand at about 7.1 billion US dollars. This is up from 6.6 billion US dollars last month with the rollover of the swap agreement with India. So, and partly also with the fact that we've been buying US dollars. In July, for example, we bought about 162 million US dollars from the market as well, the central bank. Also, when you talk about exchange rates, you have to look at our trade deficit as well. Udishan touched on this before. If you look at our trade deficit, if you see that, for example, in the first graph, our monthly exports have hovered around $1 billion of exports every month for the last 2 years. But with the COVID crisis coming in, we've seen that there's been a big dip in exports. Exports have actually dipped by nearly 26%. And we're seeing a recovery coming in with, for example, in July, I think the numbers are going to come out and we'll see that exports will probably hit about $1 billion in July. But as Udishan mentioned before, even with this recovery coming in, exporters will have to wait and see how exports do over the next, for example, in terms of textile and apparel, we'll have to wait and see how they do over the last quarter, because the third quarter has been okay pretty much. But in terms of textiles and garments, which account for 44% of exports, actually we've seen that there's a 30% dip. Imports, on the other hand, because of exchange controls that have been implemented, you see that imports have come down quite drastically from about, on average, 2 billion imports over the last 2 years. We are seeing that import numbers are now down to about 1 billion. And this has been helped actually by our biggest import item, which is fuel. So when you look at fuel, which is about 16% share of our imports, fuel prices have come down from about 62 US dollars a barrel to about right now hovering around 45 US dollars a barrel. So with this, you see that fuel has come down by about 40% in terms of our import bill, which has helped us quite a bit. So if you look at our trade deficit, last year, our trade deficit was around $8 billion US. This year, I think we'll do probably around 4 to 5 billion, because in terms of exports have been recovering, and I think we'll be able to do about $1 billion over the next 6 months for the numbers that are coming out, which that we should be able to catch up to about 10 billion, versus last year we were at about 12 billion of exports. In terms of imports, again, I think imports, as long as we are able to maintain it around 1.2 billion a month, and especially with the import controls to continue, hopefully this will be a possibility. I think the trade deficit should end up around, like I said, about 4 to 5 billion this year. Our trade deficit is generally helped, as Udishan mentioned, from earnings from tourism and worker remittances. Earnings from tourism, as you can see, for the last number of months, we've not had any earnings, and hopefully with the airport opening up, we'll see some recovery. But for the year so far, we've only made about $1 billion in terms of tourism numbers. In terms of worker remittances have actually, we've seen a pickup, and you can see that versus the last 2 years, worker remittances in July has picked up to about 700 million a month, which is quite good. One reason might be, though, the informal channels closing up, meaning because the airport is closed right now, you probably see that a lot of this money is coming through formal channels and are being picked up into our worker remittance numbers, what used to come before in terms of informal channels. So with both of these coming in, I think if worker remittance numbers stand at these levels, we should easily be able to bridge the trade deficit going forward. Also, another factor that people believe have impacted exchange rates, and which have impacted exchange rates in the past, has been foreign selling. Foreign selling has been persistent. As you can see the numbers, foreign holdings in government securities have gone down in 2013, 12.69%. Right now, 0.19% of our total outstanding treasury bills and bonds. 0.19% actually stands for about 12 billion rupees only. In context, in around 2014, we had about 453 billion rupees held by foreigners. So actually, it's a negligible number, especially given the fact that our total government bills and bonds holding is about 6 trillion in total. So as you can see, this is not going to be a major factor in terms of having problems or in terms of impacting our exchange rates going forward. Just one thing, not so related to exchange rates, but I did want to show was our sovereign bond interest rates. Foreigners obviously have been moving out of Sri Lanka for various reasons, but one of the reasons would be country risk. And country risk has not been shown in terms of local rates, versus you can see country risk better when you look at our sovereign bond interest rates. So for example, if you look at August 2019 numbers of our sovereign bond interest rate, August 2019, our sovereign bonds have been hovering in the range of between 5.5% to 6.5%, the 1 year to about the 10-year bonds. Versus we saw a big increase with our country risk increasing. The interest rates went up drastically. Prices fell down drastically in sovereign bonds. You will see that that premium has declined, especially in August after the elections and the 2/3 majority that was got by the government. These premiums have come down, and sovereign bonds still hover at rates of around 10%. The 10-year is 10%, where the local government bond right now is around 7% within Sri Lanka. So moving on to equity markets. If you look at equity market long-term returns have been quite bad. Equity markets have failed to give us returns. If you look at a 3-year CAGR, 5-year CAGR, 10-year CAGR, all have been pretty negative. Only when you go 15-year, 24-year longer term, you're looking at even a 6 to 9% or 10% return, which probably doesn't even justify the risk premium that you're taking when you're investing in a country like Sri Lanka. So equity market returns overall have not been great, and which is part of the reason also that you will see that we haven't seen a lot of investments coming into equity, because obviously why would you want to come into equity in a place where your interest rates, you're getting 9 to 10%, right? On average, if you were getting 9 to 10% on your fixed deposits, why would you want to move out to equity? So, but if you look at the recent past, this year, for example, you've seen that the market has started to pick up. Market fell drastically, obviously, pre-COVID, with the numbers coming down to about 25%. We hit a low, probably the last time we saw this was around 2009. So market came down by 25%, but since then market has been recovering, and recovering steadily 6% up, 4% up, other than July where we had a scare with the second wave coming in. So market's done about a 13% return, and year to date, the negative returns have come down to 13%. But if you take a look at foreign selling has continued even in the local stock markets. So if you see the foreign selling numbers, 2018, negative 22 billion, negative 11 billion, and right now we are at negative 32 billion, or essentially foreign outflows of 32 billion has been witnessed in Sri Lanka. And if you see, even though the market has been going up, for example, in May, we saw the market go up by 6%, June 6%. Foreigners have steadily been selling off 6.8 billion, 8.6 billion. Foreign selling has been witnessed in the market to come up with a total number of 2.5. So, and one other thing that I would like to talk about in terms of the market as well, earnings growth is pretty subdued. So when you're looking at the market, you have to keep in mind that company results are not great right now, and probably for the next 1 year, you're not going to see great results. So even though the prices are depressed and the valuations look attractive when you're looking at your PE ratios, for example, right now your PE ratios have come down to about 9 times. And although you might think that these are attractive rates, if you look at your earnings, these are some numbers. If you look at, for example, the first quarter earnings from last year, first quarter is down 25%, roughly. Second quarter, the numbers out so far are down about 30%. Quarter on quarter, again, about 35%. So earnings growth is subdued. So when you look at a PEG in the market, where you're looking at your price earnings versus growth, you're not going to see very attractive valuations if you're looking at short term. But the market is very attractively valued, I believe, if you look at the longer term, if you take a 3 to 5 year horizon, because you have stocks that are that have quite low valuations at the moment. Okay. So just before I finish, just let me leave some food for thought. Right now, when we are in a very low interest rate environment, shares have become more lucrative investments, because like I was saying before, why would you want to invest in the share market when you were getting 9 to 10% returns, right? But if you look at the central bank published numbers, the new deposit rates for July, the new fixed deposit rates for July on average have been about 5.96%. Fixed deposit rates have steadily fallen from about 9% at the beginning of the year to about below 6% right now. So even lending has fallen the same amount by about 3%. You've seen that lending rates have also come down. So in this type of environment, you see, and this is part of the reason, obviously, government is implementing their monetary policy measures as well. You see that people will want to invest in the markets. They'll want to invest in higher yielding assets, higher risk assets. So there is incentive to take on, invest in risk on assets. But some things that you might want to look out for example, like I said, in the short term, you will see that companies will go through turmoil. So although the valuations look attractive, you will want to stay out of smaller cap companies and want to invest in larger cap, more stable companies, and take a longer term call if you're investing in the market. Look out for example, dividend paying stocks. These are some things that will do well in low interest rate environments, because you will have stocks that will pay dividend yields of about 5-6%, even higher, versus right now you won't be able to get that if you invest in a bank fixed deposit. Property sector, and other real assets will pick up in these types of markets or in low interest rate markets. So these are types of stocks that you might want to take a look at. Again, dividend paying real asset sector, if you're looking at infrastructure utility stocks, these are another set of stocks that will essentially perform better in low interest rate environments. Bank stocks, in contrast, can fall, but Sri Lanka is a different question. In general, we say bank stocks will fall in low interest rate environments because banks' margins will shrink. But right now, because prices have come down so much in terms of valuations, I think you will see that this is not the case for Sri Lanka. So also in terms of bond markets, it was a very nice time to be in bond markets with this volatile interest rate environment, especially when interest rates were coming down. So anytime you see interest rates coming down, something that you want to think about investing is bonds. So I've just given you the returns of like looking at the indices of the 5-year bonds. You can see over the last 12 months, 5-year bonds have given an average return of about 24%. Even year to date, it's about a 19% return if you had invested in a bond portfolio on average of 5-year constant bond portfolio. So bond investments do give you good returns when interest rates are coming down. That's something to keep in mind. And also in lower interest rate environments, real asset stocks will rise. So property, gold, these are pretty good investments to take a look at, especially property, because there is very little access for us here in terms of getting financial access in terms of gold. But property, you will see that if you're looking at it as an investment return, you will probably look at a rental income, or you can look at capital gains. Property prices, if you look at the central bank published numbers, have not picked up so much this year, less than 2% according to the land value index. So in that sense, you see that property market hasn't started the pickup yet, although interest rates are so low. So it's a nice time probably to get into the property sector if you're looking at that. That's about it for my presentation.
Right. Thank you, Vindhya, for that very insightful presentation and comments. So moving on to the next round, before I open it to Mr. Jonas Udishan, I'd like to pose a question at him. He mentioned about fiscal stimulus by the developed countries going to the tune of 5% or 10%. Even Japan went up to 10%. Sri Lanka, their stimulus was by way of I would say another burden. I mean, they were given a concessionary interest rate loan. So I just want to pose this question: why not the central bank touch upon the capital adequacy ratio of banks, like the SRR? It was brought down to 2% from way before at 10% some time back. Then it came down to about 6%. Then now it stands at 2%. So when the Basel III rule says, we'll say 8.5, the central bank goes and tells the local banks, you have to keep 10.5 instead of 8.5. They keep another buffer for comfort's sake. So having factored that, because if you release that capital also into the marketplace, I'm sure the banks are in a far better footing to release much more liquidity to the marketplace. With that, over to you, Jonas. What is your perspective in terms of, furlough for the retain the employee sort of a grant given by the government to the employers? So the employers invariably pays this to the employee. But here what has happened, the employer takes a loan and his leveraging goes even higher. Over to you, Jonas.
Yeah, so to talk about the first point that you mentioned, which was on taking or looking at a more monetary mechanism than fiscal mechanism in general to stimulate the economy. So that's what the Central Bank of Sri Lanka has been doing up to now. So if you look at it, the Sri Lankan government's ability to spend in terms of fiscal initiatives has been very limited, given that they're running huge deficits, which is why the central bank stepped in and used the monetary mechanism in terms of using cutting rates, SRR, printing money, all that which fueled liquidity into the system. Also in terms of tier 1, if you look at it, they did cut down on the capital conservation buffer, which was brought down by, I think, roughly about 100 basis points, if I'm not mistaken, which kind of helped them to release some kind of capital to the market. As of now, we are not seeing much of a liquidity concern in terms of the market, because we are flush with excess liquidity of 180 billion rupees. So the money has been mainly come through the printing of money, government printing. The central bank holding of G-Secs has gone to 300 billion rupees, and I think that has been a prudent thing that the central bank has done in terms of covering up the fiscal shortfalls that the government had up to now. The issue in terms of why the liquidity measures are not translating in terms of economic growth or stimulus is because whatever the liquidity which is pumped in, which is just lying there in deposits and moving into financial investments, such as T-bills and T-bonds, which is why we are seeing the interest rates coming down, rather than going into private sector credit growth as such. And also keep in mind that it takes a bit of time for lower interest rates to reflect in terms of credit growth. So normally the lag is at least about 12 to 18 months that you will see. Also from the bank side, banks are being a bit more cautious than what they used to do before in terms of lending out to the SME kind of segments, which is why money is just lying there in terms of deposits and going into financial investments, rather than going into credit growth as such. So one thing that the US government did in contrast to what they did in 2009 was printing and giving cash directly to the public, the general public. So they were printing about $1,000 per household, which was given out directly to the governments, directly to the public sector or the general public, which kind of stimulated economic activity. So the indirect mechanism takes a bit of time, which is why the stimulus is not directly coming in terms of to the general public in terms of spending. So it might take a bit of time to reflect in terms of spending or GDP growth coming to the system. Also in terms of retrenchments and things like that, the central bank is looking at credit guarantee schemes, debt moratoriums. So the mechanism that has been used has been more monetary related than fiscal mechanism is what I want to touch base on. Tier 1, yes, there was a certain amount of leeway that the central bank allowed the local banks to reduce their capital conservation buffer, but it might also be prudent to keep those capital ratios at higher levels, given that there is a risk of probable default particularly in times like this, particularly if there is a second wave which comes through and if the economic cycle kind of turns around. So yes, touching the tier 1 ratios too much is not also advisable. So taking the liquidity route makes sense, but for results to come out, you might see it might take a bit more longer period of time.
Any other comment that you wanted to say before, Jonas, in terms of the risk that you see on top of
yes, so in terms of risk, what I foresee is that so we are seeing a growth cycle. We're seeing markets improving, equity markets have picked up, rates have come down. But what could change the course of the direction? One would be definitely if there's a second wave, which could spoil our entire recovery cycles, particularly if when tourism is opened up and if there is a small leakage in terms of the COVID spread, that could entirely change the sentiment in the market. Second would be definitely the fiscal issue that we have right now. The current fiscal issue that we have or the fiscal deficit that we are running are not sustainable. the debt level that we have reaching 100% in 2 years' time is unsustainable debt levels. We might go through further downgrades if we are maintaining such levels of debt. And given that we have about $4.5 billion of debt repayment, foreign debt repayments up next year, this kind of fiscal deficit will discourage foreigners to lend to Sri Lanka. So it will become more difficult for Sri Lanka to borrow in terms of commercial lending. So unless we are seeing some kind of measures taken in the form of tax increases or hard form reforms, or it could be unconventional mechanisms like selling on stakes, which could kind of ease off pressure on the government side in terms of spending. So the government will have to do something about it. We cannot keep the current level of spending for a long period of time. If we continue to take this kind of stance, we might see the foreigners kind of continuing to avoid Sri Lankan equities and debt for a longer period of time, which I see the large risk at this point of time. The second risk that I see is we printed a lot of money. We printed about 300 billion rupees to the system, with liquidity at about 180 billion rupees right now. What could happen is when the recovery cycle happens and when import controls are taken out, the excess liquidity in the market could go into imports, and it could lead to an excessive depreciation of the currency or a significant inflation. So always keep in mind that inflation is a concern, even though it is not visible in the next 2 to 3 months. On a long period of time, yes, inflation is a concern. So the central bank has to absorb back the liquidity when the time is right. When you're seeing recovery cycle starting to happen, the central bank will have to kind of start mopping up the liquidity back again. So there is concern of concerns of inflation and exchange rate if the liquidity is not mopped up again. So those would be the key risks that I foresee in terms of the market. And also, if the government continues to curtail capital spending, because capital spending is key in terms of fueling economic growth, sustainable economic growth. We can spend right now and get our 2020-21 numbers up there. But if you want to keep a sustainable GDP growth, you need to have that capital spending going on. So in order to do that, you need to kind of figure out how we are going to get the income coming in. So tax reforms will have to come in, or any other non-tax revenue forms are also welcome. But there should be some kind of capital spending which also takes place. So the government, even though there are limitations in terms of spending right now, they should look at options in terms of private-public partnerships to kind of stimulate economy in terms of capital spending. So if this doesn't happen, that means our long-term GDP growth potential will be limited, which means that equities to debt, there will be a significant threat. Also on the interest rate side, keep in mind that when rates start going back, Sri Lanka typically, as Vindhya pointed out, always had very high interest rates. So the rate cycle, when it starts moving up in a recovery cycle, you might see rates going up quite fast, and that could bring down your equity market. So, and that historical negative correlation between interest rates and equity markets have always prevailed. So if rates start moving up, you might see a dampening effect on equity prices. Over to you, Lasit.
Right. Thank you, Udishan. Let me now go to Kanishka. Before that, similarly, I just want to pose a question to Kanishka. Now, Udishan also said rather than the indirect method, you must have the money in the hands of the people. So now that's what the America to Australia, what they did. And then on top of it, I see, I saw it in one of the research paper in of central bank. The credit demand goes up right after election. The election year comes, the credit demand dips in the marketplace. It comes down to about 5 to 10% in that range. But right after the year of the election, like say 2010, 2015, now we came to 2020. So everything, you have a spike. I'm not sure whether you see this, maybe cannot see. Anyway,
it's quite difficult to see.
Yes, I understand. So there is a spike always in the middle of a election tenor. So with that, what do you see in the future with the credit demand, as well as now the banks are willing to lend? There is a survey even done on that by central bank. They say they are willing, but the SMEs and the consumers are not willing to take. But as Udishan also mentioned, the state SOEs are willing to borrow. So that is obvious. Now with the vote of accounts, they are hoping to mop up another 750 billion from the marketplace. In that backdrop, that is 750 billion in the coming quarter, like the second half of the year. So in that context, and how do we manage it? I think there was an internet connection. Did you hear the last bit?
Yeah, so it came out okay. I think I can work with that. So yeah, Lasinta, to answer the first part of your question, I mean, seeing credit demand spike right after elections, I mean, what you generally see is that any government which comes into power tends to give a little bit of, how do you say it, some freebies to the, general populace. I mean, you saw this with each of the elections. I mean, even in the 2015 one, you saw government sector salaries going up, you saw vehicle import duties coming down. And one thing to keep in mind is why you see credit growth coming in right after election is primarily because of these changes to import duties. Moment it comes down, people go and borrow and buy a vehicle, and that's why you see this little cycle coming and going. This time around, do we think it will happen? Unlikely with the import controls in place. But I mean, what everybody else was telling earlier as well, I mean, there's a lot of pent up demand in the system, which can lead to, a sudden demand for credit once your import restrictions are taken off. Simple thing, if you look at the increase in the savings in the banking system right now, there's close to, in the first half of the year, there was an addition of close to about, I think, 170 billion, which was never seen, say, on the data going back into 2008. I think one positive impact out of the lockdown was that people saved a lot more money. People were stuck at home, they couldn't spend it. So even with some of the banks which we were speaking with, I mean, they were saying that they saw the remittances by local remittances coming down, but the savings balances actually increased because people couldn't go out and spend it. So in that sense, it all comes down to when will import restrictions be eased or taken off to a large degree, which is what's going to really drive your credit demand and send your interest rates upwards. And one thing I would like to stress upon, as Udishan was also saying, that this limited imports on capital goods is going to be a big problem for us if you continue to restrict that for a longer period of time. Your economic capacity will come down. But I think right now what the issue is that people are seeing a bit of excess capacity in place, but once things start recovering, going back to normal, you will see that maybe other countries have put in place the capacity which we could have catered to. A key theme is diversifying away from China. What are we doing in terms of the longer term picture to capture that demand? A big question mark, right? So that's my view on the primary part. I mean, in terms of the risks, though, I mean, for us, when it comes to the fixed income side, one of the biggest risks we see is on the credit rating side, which is something that people tend to focus a lot on. But in current conditions, your credit rating can lag ground reality to a large degree. I mean, you saw this during previous crises as well. So what we would say is a focus on cash flows and balance sheets. It's going to pretty much be a must investing in this kind of environment. other than that, I mean, the main risk which we see is, when are import controls going to be reduced or removed, or what do we see happening on that front? Over to you, Lasint. I mean, does that cover your queries there?
Anything else you were planning to discuss apart from what I asked in terms of challenges?
Yeah, challenges right now, obviously, is, I mean, you have a very interesting situation where, people who we want to lend to or invest into don't want investments, and people who you really don't want to invest to want money. So it's a bit of an interesting situation, and I think with these interest rates which are in place, there is a bit of quite a large disconnect between the risk that you're looking at versus the return that you're getting. So which is a bit of a problem that everybody's grappling with right now. Yeah.
Right. Thank you. Thank you, Kanishka. Moving on to Vindhya. Before you start on it, I just take a quote from, say, this is Central Bank of Sri Lanka Financial System Stability Review Report 2019. Now it says as at the second quarter of 2009, rather the second half of 2019, the priority of risk the country had, the first thing was the political risk. Then the second thing was second priority was issue was the terrorism. Then the third issue was the macroeconomic policy uncertainty, policy implementation, policy formation is the third issue. Then the fourth issue is loss of investors' confidence on the economy. Then the fifth issue is GDP growth. Then the sixth, asset quality deterioration. Seventh is cyber attack and phishing, etc. Number 8 is foreign exchange risk. Number 9 is inflation. And number 9, equally inflation and interest rate together. Then number 9, once again, public governance, transparency, and corruption. Now, if you really see I would say, how the financial markets and the investments are made, I think it goes beyond just the numbers only. It is the way we do things and how we govern the country. So in that context, how do the foreign investors and even the investors locally, they perceive the opportunities in the marketplace, Vindhya?
Sorry, how do the locals and the foreigners perceive opportunities in the marketplace, is it?
Yeah, in the context of these kind of risk being the priority in terms of having a stable financial system.
Right. So in terms of some of those risks, Lasintha, some of those risks would have been addressed by now, right? For example, political risk, to the extent that the elections have been held, there's been a clear majority, and with that, there's you would have a mandate to be able to execute policy without or execute policy in the way that they require. Some of these risks would have been addressed. I think in terms of the risks that are important to be addressed is probably one, investor confidence. Sri Lanka right now is rated B- by both Fitch and S&P. Moody's is still evaluating our rating. We haven't been downgraded yet, but in March we got downgraded by both Fitch and S&P. So investor confidence is something that we would need to address. There is, like I showed you in my graph on the sovereign bonds, actually the sovereign bond yields went up to about 96%, now back down to about 20%. These spikes, obviously part of the spike was the fact that the sovereign bond, I mean, we have very little bonds in the market, only about $15 billion in total sovereign bonds. So not a lot of liquidity, even small changes will lead to big spikes. But nonetheless, the spike shows you that there is a perception of risk that foreign investors think about when they look at the country. So that is one thing that I think you would need to address. And in terms of these risks, I think inflation and forex go hand in hand together. Is something that you would have to look at and address. The fact is that Sri Lanka is a net importing nation. No matter what, if you look at our past 10 years, we have our currency has depreciated on average by 5%. We can't expect that our currency will appreciate in the long term on a continuous basis, let's say. But I think some of the talk now or some of the sentiment with the investors is that currency will appreciate, interest rates will stay at these, or not continuously stay at this, but with these, even with these low interest rates, maintain low interest rates and maintain currency. So this again is an issue, because obviously you can't maintain the two together. If your interest rates are going to come down, you'll see that your currency is going to depreciate as well. Plus, with our import restrictions being coming down next year, or essentially with us coming out of these import restrictions next year, you see that there will be pressure coming in on currency. You don't even have to wait till next year. You see that September currency, some pressure will start coming on currency, because most of these imports were bought with a 6-month lag. So the payments are coming up due for March imports. Now you have to make the payments in September. So starting September, you see some pressure coming in on the currency as well. So these are some of the risks that I think that you would need to look at and address if you're looking at building investor confidence. Because I don't think that, although we'll be able to, without a problem, pay the sovereign bond, I don't think there will be a problem paying the sovereign bond that's coming up this October. I don't think that we will be able to probably raise another sovereign bond or money going to the capital markets at the same rates right now. So if we want to have a diverse portfolio of investors and not just rely on certain, a set of investors on multilateral or agencies or whatever in terms of our foreign borrowings, we will have to diversify in order to diversify our risk, we will have to address these concerns.
Thank you, India. Apart from that, any other thing you wanted to say on challenges where the investments are concerned, especially in relation to capital market?
So in terms of the stock market, I think one comment I would like to make is a lot of people are very optimistic. And I mean, I'm not saying we are also optimistic. Certainly the prices are attractive to buy. But you have to be very cautious in terms of the fact that companies are still not out of this turmoil, and there is a lot more to go. And you see easily, for example, if you take bank NPLs are going to double, but we're not going to see this. We're not going to see this when we look at our results, because of the moratoriums given. Most of these results are not going to be seen in the same way. And I'm talking about bank NPLs, not because of banks. I'm talking about bank NPLs to reflect on as a reflection of the economy, where the economy itself has still not recovered. So when you want to invest in the market, I think you have to look for companies with a long-term horizon, which you think will survive that turmoil going forward.
Right. Thank you, India. Let me take a question from the panelists, from the audience. I think this was covered. How would government of Sri Lanka would refinance its external debt with negative primary balance and huge budget deficit? Udishan, I think you address this, but he's asking how would the government of Sri Lanka will refinance its external debt? How do you roll over now in the event of if we are unable to go for sovereign bond issues? How can we see that the borrowings have been will be serviced. Udisha?
Yeah, so if you look at 2020, so we are left with about $1.1 billion of sovereign debt repayment towards October. So that's not going to be much of an issue given that we have reserves running at about $7.2 billion now. So the most likely scenario is that the government will pay out of the reserves, at least the $1.1 billion that we're talking for 2020. But the bigger problem that we foresee is the refinancing of about $4.2 billion, which are pending for next year. So you can't keep on using your reserves, because if our reserves are down to about 6 billion by the end of the year, you're left with, and if you use 4.2 billion or 4 billion of it next year, that means you're down to about $2-3 billion, which is not sufficient in terms of import cover. So normally your minimum that you need to keep, the standard is about 3 months of imports, which will work out about $4.5-5 billion. So the options that the central bank and the government will have is to look at bilateral and multilateral agreements, either China or any other country of that sort, or it could be even lenders like IMF, which we might have to go for if you're looking at financing this deficit, this foreign debt repayment. If not, we will be left with depending on domestic borrowing, which to finance a fiscal deficit, which will mean our rates will shoot up domestically. So most likely scenario is that we will opt for bilateral and multilateral lending, but keep in mind that these will come with conditions, especially on in terms of increasing your taxes, because they will impose covenants in terms of keeping your fiscal balance and your debt position under control. Going to the commercial borrowings right now seems challenging, given that sovereign bond yields are pretty high right now. If sovereign bonds yields were lower, we would have definitely gone for the sovereign bond market and raised money from the sovereign market. But it doesn't seem like the best possible option right now, which means that we will definitely have to depend on bilateral or multilateral funding arrangements. And also, if it is possible, to get debt moratoriums from our lending countries like China. Still, even though we have been in discussions for a long period of time, the government has not been able to secure something of that sort as of now. But if not for bilateral and multilateral agreements or for debt moratoriums from lending agencies, we definitely have a problem in terms of debt repayment next year.
In this context, Udishan, what are the opportunities you see for the investors in terms of alternative investment choices? Now, India said about property and maybe precious metals, but then the property and precious metal, it can cause a cash flow issue, because like if the property also cannot be rented out or made any economic use of it, then your cash flow gets stuck, right? So of course the capital appreciation will be there. If someone's looking at a regular cash flow, where do we look at?
Yeah, so on particularly in low interest rate environment, equities is kind of attractive right now, and we are seeing investors moving into equities with the low interest rate regime prevailing and the valuations being pretty low. So even though companies are not doing that well, on the expectation that things will improve over time, and then given that you don't have an alternative asset class apart from real estate, there is still demand for equities. And we still see certain pockets of the equity market still being attractive, as Vindhya pointed out. Dividend yielding stocks, leave out 2020. When you get back to 2021, if things get back to normal, you might be getting 8 to 10% yield on certain companies, which might be greater than the interest rates that you're looking at right now. Also, in terms of real estate, what I foresee is that land will be one of the key asset classes that investors will be keen, and we see demand building for it right now. There are a lot of inquiries going on, especially on land outside of Colombo, in emerging locations outside of Colombo, which could be potentially between 30 to 1 hour distance from Colombo's CBD. I'm not particularly bullish on apartments, given that there has been a glut of apartments which have come in, and it's beyond the average investable amounts of what a normal middle income family could afford, which is why I think land plots outside Colombo could be a potential investment vehicle that investors could look at. Also, apart from that, you can still look at assets in form of office space, warehousing, which still are yielding about 7% dividend, 7% rental yields. Which is where REITs could come in, when if Sri Lanka has recently introduced REITs. So if a REIT product is introduced to the market, yes, I believe that could yield some kind of return, which is current return in the form of rental return coming out every year, in addition to the capital gains that you could expect. And keep in mind that real estate has always proven to be an inflation protective instrument. So if there is a possibility that there could be an inflation or exchange rate depreciation in the next 1 to 2 years with import controls being taken off, real estate and property could be one asset class that could really do well. Commodities, on the other hand, the prices have shot up too much, is what I believe. So things like gold, there is no commercial value. It's more of a speculative value that we are seeing in gold right now. So I'm not particularly bullish on commodities right now, given that they have appreciated quite significantly in the recent past. So my top picks would be going into equities and also on the real estate front, land and outside Colombo properties.
Thank you, Dishan. Coming back to Mr. Pereira, Kanishka, in terms of the strategy, what a fund manager should do in this context, what is your advice to people in terms of fixed income sources, managing fixed income?
Yeah, so Lasinda, before I come to that, I mean, one thing I would like to add to what Udishan said in terms of bond maturities next year, about the 4 billion or so that's supposed to go out, and where there might be a refinancing problem. You're literally talking about, I think the main issue is on the $1 billion sovereign that's maturing in July. And you have about $1.3 billion of about SLDBs which mature, which people find it easier to roll over, and the rest are multilateral ones, which generally are refinanced. So I think the government's major headache right now is for sorting out something for the $1 billion in July, rather than trying to figure something out for the full 4.2 billion. So if you get some of these things, which they are working on, comes into play, I think most of that risk goes away to a certain degree. Obviously, I mean, SLDBs had some issues in the past few auctions, but what we've seen in the recent ones, which were concluded, I mean, they were taken up reasonably well because the dollar rate is still attractive on those. And moving on to your main question there in terms of, how would you allocate on your fixed income side, or broadly in terms of the asset allocation. So, I mean, I agree with the other panelists that equities do have scope for growth for sure. So our approach there is two-pronged. I mean, we will do, most of our allocation will be relatively short-term trading strategies. It's what we would look at. More in terms of who would benefit out of, the import restrictions. And one of the key themes that is appearing right now is obviously on the construction side, with interest rates where they are, people buy property and they might not start building right now, but over time, fairly confident that people will. So that's a key theme that we're looking at. Now, the other thing that we are kind of quite interested in on stocks which were particularly battered by this coronavirus, which is, I mean, I would say, to put it out there, I mean, it would be the leisure sector. But I mean, you're looking at a 3-year investment horizon. But if you have staying power, I mean, this is something that you should look at because it can generate substantial alpha into anybody's portfolio. But obviously, you need to select your stock. Stock picking is very, very important. So you need companies with a good balance sheet, good properties, have a good brand name, etc., and slowly collect those and be prepared to hold on for 2 to 3 years, which can generate good returns. On the fixed income space, though, I mean, it's fairly straightforward for us. Our focus is on high quality issuers, and we focus more on the short end of the curve. We wouldn't invest more than 6 months in fixed income paper right now. Because, see, for example, if you lock in, say, a 5-year paper at 10%, and with there's more risk of interest rates going up than staying where it is or going down, we think that you will miss out a lot if you lock in long-term rates now. So stay short, stick to good companies with a solid balance sheet and good cash flow is primarily what we would look at in terms of the fixed income side.
Thank you, Kanishka. Now moving on to India. With regard to the opportunities in this situation and having grasped whatever, and maybe finding the vaccine for COVID. Right now, already the US market has responded to the third stage of the research, or rather finding the vaccine. The third stage, there are about 5 companies moved to third stage, and the US market is at about RSI 80 plus, and with a P ratio of 30 times, and India is running at about, even still at about 25 P ratio. So in that context, now Sri Lanka still we are trailing at 9 times PER. So what is your advice in terms of having a portfolio built, and how should we strategize in terms of our investment? What do you, India?
Yeah, I think, okay, so for US, although their P's are 30 and the stock market has performed really well, I think we have to be a little cautious here. One of the reasons that the stock market is performing so well is not because the companies are going to do well. It's because there is easy money. There's a lot of money that's been printed out there, and most of that money is being routed to the stock market. So you see that the stock market right now in the US is a bit divided in terms of the risk that they're looking at versus the easy money that they're pumping into the market. So in that's part of the reason why you're seeing the market go. And even in Sri Lanka, you're seeing the market go. Most of it is because we are seeing a lot of there is not a lot of alternative investments that you can have. And like Disha said, number one pick that you have, then the easiest thing to do is to invest in the market. So one of the things, like I said before, what you have to look at is not the PE ratio, it's price earnings to growth. Our PE ratio is 9 times. Sure, it looks cheap when you look at probably the region, but what is your growth potential? Short-term growth, I don't think you can even think about it, forget it. Because if you look at short-term growth, we have been continuously degrowing, and this will continue over the next couple of quarters. So, but if you take a 3-year view, you have to take a view in that sense on what you think growth is going to be, and then you have to make a call. You can't just simply say that the PEs are cheap and therefore we should be looking at growth. Sorry, looking at investing in the market. Sorry, Rasit, what was the second question?
How do you formulate a strategy to have a portfolio, and what sectors, or should you be in fixed income part, or maybe capital market? What percentage sort of, how do you build a portfolio of that nature? moving forward? And
Have no restrictions in terms of building your portfolio, I don't think right now is the time to be in fixed income. I think both Udishan and Kanishka said pretty much the same thing. You have to diversify away from fixed income, because what I showed you in terms of different opportunities also, most of these opportunities have already been taken. So for example, I said bonds will give you good returns, but bond returns have already been got. Bonds have already come down. Prices have already gone up. Interest rates have already come down. Gold, we don't have access to investing in gold, but gold prices the same way has really moved up. Gold hit an all-time high of over 2,000 6th of August. Although right now it's trading at around 1,950 or something like that. So most of these returns, some of them we don't have access to, but most of these returns have already been taken by investors. So there are very little alternative opportunities, and some of the alternative opportunities are easiest one is the market. A little more, you'll have to put in a little more capital. You have to, I think property is a really good time to get into, because even if you look at the indicators, if you look at the central bank published results, for example, the central bank publishes the land value indicator on a half yearly basis, and you will see that these land value indicators, this mainly looks at the Colombo area, but prices have gone up only about 2%. You've not seen a big pickup in terms of property prices. Same thing if you look at these websites in terms of property selling websites, sites that sell property, they publish indicators from time to time, and even these indicators, you see that there hasn't been a big pickup in terms of prices, apartments or houses or land, whichever way you take it. So still those gains have not been taken. There is potential. So property is an area which you can certainly look at. Like you said, capital is an issue, but if you don't borrow now, when are you going to borrow? So if you have the capacity to borrow, I think this is the right time. The right time to take a loan. And obviously banks, if you have decent credit quality, banks are looking to lend any which way. So I think, and you'll get pretty good rates as well. So property, we don't have access to any of the investments. Unfortunately, REITs would have been a good opportunity or a good way for us to get into property, but the REIT registration just passed and we don't have any form of REITs in Sri Lanka yet. So that would have been another great opportunity if that was available, but it's not. So we have to go for physical assets per se, if you're looking at it.
right. Thank you, Vindhya. And there's a question from one Raghu, Mr. Raghu. It's open to all the panelists. Given 1/3 of market cap is from banking sector, can you all give some insights on impairment reporting of the listed banks once the moratorium ends by end of September? Already we see from reported earnings, some financial institutions have front-loaded impairment. Do you think going forward, impairment would range bound at current level in the coming quarters? Who would like to take it? Udishan?
So in terms of impairments, most of it is not yet recognized. Some banks have provided, but it's all a guess. You're looking majority of it because still the customer is not paying any dues. You don't really know whether a customer is going to pay you or not. So most of that you'll only realize it towards next year, given that your moratoriums are extended. So most of the impairments will come in towards the latter part of or second half of next year. And also keep in mind, the impairment cycle takes a long period of time. For example, in 2015 and 16, the impact of the floods, the droughts, it went up even up to 2018-19. Because initially what the bank does is they reschedule the loans, there's a lot of restructuring done, and eventually only it will reflect in terms of impairment. So the impairments will happen over a period of time. So I believe that most of the impairment is yet to come, and it will definitely come once the moratorium ends. What to look at is which banks have a suitable or sufficient provisioning cover right now? What provisioning cover basically means is how much impairment provisioning have you made already for the existing NPLs? So if your provisioning cover is greater right now, those are the banks to be comfortable with. The banks which with low impairment cover are the most vulnerable in terms of taking a larger hit once the debt moratorium comes through. But to be honest, as of right now, none of the banks are even able to comment in terms of what kind of impact will hit them in terms of impairments in the next 6 to 12 months.
Right. Thank you, Dishan. This is a question from me, basically. In this context where most of the companies are like saddled with high leverage situation, do you think if they start listing in the capital market, do you think the IPOs will be taken up, or how can they come to the marketplace and seek capital to infuse and to stabilize the company?
There is definitely a demand for equities right now, given the liquidity. There's no place to go. So IPOs could actually work. If you look at the Southeast Asian countries, there have been really good companies which have come out and IPO. There have been love companies who benefited from COVID, which actually came in. Their share prices have shot up from the price of the IPO. So there are parcels of the economy which could ideally list right now, which are actually benefiting from COVID. So investors are also not being very short-sighted right now. They are looking at companies which will show performance, which will turn around. If there is a story, I'm sure that investors will be keen to look at new IPOs in the current market context. But keep in mind that investors have gone through bad experiences with IPOs in the last 5 to 10 years. So there is a bit of caution that investors will also put into in terms of investing in IPOs. So as long as there is a solid growth story, fundamentals backing the company, yes, there will be demand. The investors are looking out for investment opportunities right now. And keep in mind that liquidity wise, we're only talking about 10, 20 companies that investors can, or the big funds can invest. So if there is a company which is fairly large in terms of size, which comes at good valuations with a good story, I think it's a really good time to come in terms of IPO listing.
Yes, it's all about pricing, right?
Just to add to that, I think one other thing is that most of these companies who you would have thought required capital and will be open to taking on more equity holders, say back in March, April, it's not the case with the moratoriums right now. So there is a whole load of distortion that's happening because of the liquidity in the market and the moratoriums. But eventually it will happen once those are lifted out. Timing remains an issue.
Right. On the same topic of capital market, now I see Sri Lanka, we have only about 286 companies listed. And for a given day, it's only about 240 get traded. Rest of the 40, I would say, I think it's in the blacklist, or it's in the default board. And in other countries, especially in China, there's about 25,000 companies listed. And in Japan, it's about 25,000 companies. And more than that, the trading, frequent trading, which takes place now in Sri Lanka, average last year, it's about 700 million on average per day turnover. But in other countries, like say in Hong Kong, they have about 10,000 listed, but they have 2.5 billion on average turnover in the market. Don't you think in Sri Lanka, our fee, the brokerage fee, which is 1.112 one way, then both ways you are looking at about 2.224, is quite high in terms of, say, if someone wants to really trade and get into the stock market, shouldn't there be a time-bound fee structure introduced, so then more people will start trading, because to make 2% even in this context is very difficult, because now India also showed, if you see the CAGR for the 3 years, 6 years, 10 years, you have to go to 15 years to make a positive growth in a holding equity, right? Of course, if you buy low and sell high, that's a different thing. But when you're a fund manager, you don't have that luxury of trading, right? So don't you think there should be a structured fee on your share trading commission to the brokers, and which is shared among the CSE to SEC and all of that? What are your comments? Anyone wants to take it? It's open to either of you.
I think, I mean, all of us would be happy if there are lower trading costs. I mean, there's no argument on that. But what needs to be kept in mind is that roughly half of that is still government taxes, cessors, this, that, and all that, right? So 64 basis points of a trade is that. So yeah, definitely there needs to be some reform. But another thing to keep in mind is you're looking at a market with 20 plus stockbrokers. So those are little things that, you know, are the reason for high broking fees in this country.
How can we influence, I mean, the majority of the people to get into the stock market rather than just going to the bank or going into fixed income sources? Why not the capital market? Is it the education is the issue, or is it we have not, they have burned their hands in the past, or is it that the companies listed are not, I mean, conveying the right messages? What can we do about it?
I mean, it's a bit of everything, right? I think the financial literacy in Sri Lanka is very low. And that's something that has to be addressed from school level itself. For certain people are not comfortable investing in the stock market. Forgetting the stock market, they're not comfortable investing anything in most other products other than bank fixed deposits. So financial literacy is something that really needs to be addressed. And I think little steps are being taken, but it has to go there. Second, like you said, definitely you have to give people positive experiences. 2011-12, people had very negative experiences investing in the share market, which is why you saw that they kept away for the longest period of time. So positive experiences are important, corporate governance is important, and I think these are some things that you have to think about when you're investing.
So to add to that, also in terms of the government and policy direction, there's not been much consistency in terms of the policy adopted by the different governments coming into play. Today you have a different structure. 2 years down the line, you have something different running. So investors are also not comfortable in terms of locking in money. With equity is more of a long-term investment asset class. So you're not really comfortable locking in your money for 5 years when your policy is not consistent within that five years of time. Second is from a corporate perspective, as Vindhya pointed out, governance is really important. How many companies have proper governance procedures in place, and are proper practices taken in terms of, from a regulatory perspective, in terms of looking at whether companies are following proper corporate governance policies in place. If you are a retail investor, what kind of information is available out there for you to figure out how a company is doing? Just have an annual report and a financial statement out there. But if you go to a company overseas, you have a lot of material out there from investor presentations where companies share what they're doing right now, what the outlook is, what kind of targets that they're looking at. So there's a lot of guidance from a corporate perspective as well. So from a regulatory perspective, those should be encouraged as well, which could bring in the retail investors into the market. So it's education from one angle, but corporates and the regulatory perspective should also come into play when you're getting the retailers out there.
Right. Now, through the discussion, many issues came up with investor confidence and even the entrepreneurs not knowing what will be after 5 years. Every 5 years, the policy changes. Now, isn't it the best time even the opposition and the government come together and have a national policy which is being taken irrespective of which government comes into power? You stick to the policy what is drawn, maybe like India. I mean, governments come and go, but their foreign policy to whatever the internal economic policies, they stay the same, more or less. So isn't it a great time for us to do that? Anyone wants to take it? Dishan?
Yes, I would think so. Given that this government has 2/3 majority and some kind of conviction over the public, I think this is the right time to do it. But at least if they could give the assurance, if it will last for 5 years, that is more than enough for the retail or the average investor. It's not only the retail investor, talking about foreign investors who have completely missed out, who have long-term horizons. They have insurance portfolios which invest for 5 to 10 years. So they need consistency, at least 5 years. If the government can say that this is the tax policy that they're going to follow for these 5 years, that is more than enough for investors to get into the market.
Okay, hypothetically thinking now, say if a bubble burst in American stock market, this is a zero-sum game. There is a winner and a loser. So whoever wins, they will have to now park their money elsewhere. So do you think they will look at emerging markets, or where will they go to park their money?
I think to answer that one, Lasintha, I think it depends quite a bit on what they perceive as risk, right? So yes, there are some other emerging markets which are rather attractive, let's say if a bubble bursts in the US. But from a fund manager's point of view, if the US is generating consistently good returns every month, you are not incentivized to go, take adventures out into emerging markets or frontier markets and, answer to your shareholders why you are generating such poor returns. So that is actually a real problem that Sri Lanka will face unless we start showing performance. I mean, we are not going to come up, and there are plenty of other frontier markets and emerging markets which they can go into without having to deal with Sri Lanka problems.
Right. I think we covered quite a lot, and I would say many aspects in terms of investments, opportunities, risks, challenges. So thank you so much for your wealth of knowledge shared with us, Udishan, Vindhya, and Kanishka. Before we wind up, I'd like to invite Samira to give a word of thanks, and thank you very much, the participants, for being with us. Stay tuned for just another 5 minutes. Thank you, the panelists. Over to you, Samira. You're on mute, Samira.
Okay. Thank you very much, Lasintha. I think we had a great discussion today on the for post-COVID financial markets, and I think it's a timely topic with these 3 industry experts sharing their views on the post-COVID financial market. And I think as MBA Alumni Association, so we thought this is kind of a more relevant and a more timely topic for an in-depth discussion. So what are the mainly to discuss about what are the main challenges and what are the strategies that we can use to overcome this kind of situation and to optimize our investments. So I think we have got the best panel to discuss it from the research backgrounds and fund management background. So without taking much time, I'd like to thank all the people who supported for this event. And firstly, I would like to thank all the speakers for gracing your important work and sharing your valuable thoughts and insights with us. Ms. Vindhya Jayasekara, NDB Wealth Management Limited, the Vice President, and Mr. Udishan Jonas, Chief Strategist at Capital Alliance Limited, and Mr. Kanishka Perera, Chief Investment Officer at Asia Securities. Thank you very much again for your valuable thoughts and your time spent with us. So then I'd like to thank, I send my sincere thanks to the Mr. Lacinta Ferdinando, the moderator of this today's event, our Albina member and principal consultant at JKC Consultants. Thank you very much, Lacinta, for your all hard work and all efforts you have did for the event. And I'd like to thank Ranga Ratnayaka, President of our MBA Alumni Association of University of Colombo, and all the entire EXCO team for the supports and guidance given to us to make this event a success. And after that, this is a kind of a, we cannot do this kind of a event within overnight. So I had a kind of a great team behind me. So I would like to thank this, take this opportunity to thank all. I'd like to thank Mr. Upal Ratnayaka, Mr. Kulendra Sivaram, and Dulanji Silva, and especially Ishani Tenur and Mr. Prabhat Kaushalya, who are instrumental in the concept development and connecting all the panelists for the event. And thank you, Mr. Neil Dimel and Ms. Hema Maya Dunne for member communication, and Mr. Prashant Costa for creating a beautiful flyer for us. With connecting with Ishan Bright Ideas. So thank you very much, Ishan Malshankar, for the wonderful flyer. And as usual, Suraj Radampola always giving us the technical part support for a smooth run in the webinar. So thank you very much, Suraj. And again, Delhi FT joined with as the media partner for the event. Thank you very much, our good friend, Mr. Nanista Kasim, and the Delhi FT team for the support given. And also our online media partner, the International Institute of Knowledge Management, TICAM. Thank you very much, especially Duminda and the TICAM team for the wonderful support provided for the webinar platform. And again, I should thank HNB Assurance PLC, a leading insurance company, who came us on board as the main sponsor for this event. And finally, I'd like to thank all the audience who joined with us today for this, informative session, because they are our strength. And thank you very much for the time. And we hope your presence in the future events also, and from the MBA Alumni Association. So once again, I'd like to thank all the speakers and the audience for your valuable time spent with us and being a part with us. So thank you very much. And Lacinta.
We've been with you at those special moments in life. We've seen you selflessly impart of yourself to uplift those you love. Joyous were we while you've cherished their achievements. We believe you are blessed to love and be loved. Strengthening every step of your life, winning your trust above all. We are HNB Assurance.